Can we explain the difference between the cash flow and the profit? This is sometimes called a reconciliation. So let's start with the profit. All other things being equal, we would expect that the profit for the period, 5 in this case, would be the same as the cash inflow. And in this period it was. There are no differences between the cash flow and the profit in that first period. Okay, let's have a look at the second period. Let's move that. Like that. What's the profit for the second period? 6. What's the cash flow for the second period? None. So what's the explanation? This needs to be a -6. -6 is the amount of credit we've advanced. So credit given. We extended credit of 6. So our cash inflow for the period was none. And the reason is the customers have got the 6. We haven't collected it yet. This is 6 in their bank account, representing 6 that they owe us. So the profit and the cash flow are reconciled by, the difference is explained by, we made sales of 6, but we haven't collected yet. We're giving credit to the customer for that amount. Okay, let us think of another transaction now. Let's say we collect half of that money. So collect half. So we collect half of that receivable. That's a cash collection. And net assets haven't changed in this period. We've got a receipt though, so the net assets haven't changed because we were owed 6, we've collected half of it, which is 3. So we've changed half of our receivable asset, money owed to us by the customer, into cash. So 3 moved from their bank accounts to ours. So we transformed one of our assets, non-cash assets, into a cash asset. So we've got receipts of this amount. Our cash inflow was 3. We haven't given credit, but rather we've collections. So yeah, let's say collections. And this item is an add-on. So it's the difference between the closing and the opening balances. This time we've got a decrease. So the cash inflow is 3 for the period, explained by, although there was no profit, we collected 3 that we were previously owed. One other sort of transaction we might have. What if we issued a credit note? So in other words, let's say there's a dispute. So issue credit note, we tell the customer you don't have to pay us anymore. Issue credit note. So they did owe us 3. Let's say the credit note is for 2. So the receivable goes down by 2. What else is going to change? The other item to change is going to be our, in this case, income statement. So our net assets have gone down. And the reason for that is a sale we'd previously made. So we'd booked some income. We're now telling the customer, you don't have to pay us for that. So we need to reduce our income. So we've got negative income, we've got an adjustment. Adjustments for previous periods, we've got a loss for this period. So our net assets went down because our assets went down. And the reason our assets went down is because 2 of the sales of 6 previously booked, we've now appreciated were not sales. With hindsight, they're negative sales for this period. So our reconciliation says we made a loss in the period, so loss in brackets. If we make a loss, we would have expected a cash outflow. However, we didn't have a cash outflow, and the reason is, say, reduction in receivables. So our receivables reduced by 2, being the difference between the opening and the closing. So cash flows in this period were none. We've got a movement in the balance sheet, and it's movement in the balance sheet associated with, in this case, a credit note. In the previous case, it was a collection. In both cases, the cash position is better than the profit would have suggested.